So I thought I'd make a portfolio update this week or early in the week. I didn't expect my equity to jump this quickly from last week. I think it's probably because of Monday and Tuesday's rally. So I'm recording this video February 4th at 5 a.m. as you can see here, but I'll probably be uploading the video at 6 p.m. today. So this is my equity as of February 3rd, 5 p.m. Eastern. So I'm sitting at 117,944 Canadian. I've got 31K in stocks and 86K cash. Now I know the allocation is pretty bad. I should be spending at least 50-50. So I've got too much cash sitting not being invested. And that's just because, like always, I'm just not too sure what to invest in. Everything's so expensive. Everything's at all-time highs. All right, so I've got 4 accounts with Questrade. I've got margin account, TFSA, RSP, and RESP. So I'm going to go over each account and show you what's inside and what I plan to do in them. All right, so first thing, let's start off with the margin account. Right now, the margin account has 0 cash and 10K US cash. And what I'm holding in my margin account, what I'm usually doing in my margin account is I sell options. That's all I do in my margin account is sell options. And right now, these are the positions that I'm holding in my margin account. So I've got a BABA put spread. So this is a very old put spread that I was trying to roll and save. And so it has a February 19 expiry. The short strike is 255 and long strike is 250. It's a put credit spread. Basically, I win as long as BABA stays above 255 come February 19. BABA right now, I think pre-market was around 268. So it looks good right now, but it kept getting breached often, this put spread. So it kept dropping below 255. It even went to 212 at some point. But right now it's back up and I got 2 or 3 weeks to go and I just needed to stay above 255 and this trade can expire worthless. I've got the rest are all naked puts, so cash secured puts or naked puts basically. So selling a naked put on these underlyings. I've got Curiosity Stream. So I've got 2 different strikes but the same expiry, but each one contract. So initially I started off with the 17.5. I sold it for $3. It's now worth $3.70. So it's showing a small loss of $70 because the value of the put option went up. And then I sold another one at a 15 strike for $2.10. And that also went up. It's trading at 221, so it's showing an $11 loss. But basically, I just need the stock to be above these strikes by March 19 for me to win. Typically, what I end up doing is I close the trade earlier if the value of the put option drops. So for example, I sold this for $3. If it drops to, let's say, $2 or $1.75, then I'll buy it back. I'll close the trade, and the difference is my profit. I've got a Fubo naked put at a 30 strike, March 19 expiry, collected $3.30. So this is one contract, so it's times 100. So that's $330. Right now, I can close it for about $255. So that gives me $75 profit. I opened the trade February 2nd, and we're February 4th today. So it would be a 2-day trade. But I think I'll hold it a little bit longer. Maybe under $2, I'd close the trade. And then I've got HIMS or HER, March 19, 17.5 strike. So it's also a naked put. I collected $2.55. It's worth $1.90 right now. So it's sitting on it's showing a $65 profit. And finally, this was a scary one for me because it takes a lot of capital. This one takes about $5,000 of maintenance excess. And I did this trade because Spotify dropped hard after earnings yesterday. So it was trading at around $3.50 and it dropped to $3.10 almost yesterday. It dropped to $3.10. So I like to sell puts on red days so I can be further away. So my strike is further away. It gives me some sort of edge. So I sold the March 19 expiry. I sold a 270 put on Spotify, collected $6.50. So what's risky about that, or what's scary about that trade for me, is what if Spotify continues to drop gradually as we get to March 19? If that happens, well, there is time decay, so the value of the options will drop, but because the stock is dropping, the put option might increase in value as well. And if that happens, then I'll be sitting on an unrealized loss. Not only that, but as Spotify drops, the capital requirement of this stock will go up. So if Spotify, let's say, reaches 270, the capital requirement for this trade will be about $8,000. So that's the scary part about this trade, is that it's taking up too much capital. But I was couldn't resist it. The drop was too big for me not to sell something on it. So decided to sell. I decided to take this trade on. We'll see what happens. So in my TFSA, so all the 3 remaining registered accounts, so TFSA, RSP, RESP, I've been back and forth, but I'm leaning towards using it to buy stocks and to buy and hold stocks, growth stocks especially, because I've seen a lot of stocks lately just double, triple, and even 10x, and I kind of want to participate in that. So I'm thinking of just using the registered accounts to buy these stocks on a dip, and just to always put in $1,000 at a time to dollar cost average if I have to. It feels safer, it's less stressful, and it's kind of fun to just buy and just hold, never have to care, and just see what happens. And you get to participate in capital appreciation, even though it takes time. Sometimes a stock can go up and then come back down below your initial purchase price, so you feel bad not selling it the first time and confirming that profit. In my TFSA, I've got some dividend stocks, and I kind of enjoy just buying them once and never touching them again. I like that, kind of enjoy that feeling. But of course, I'm not going to do that in all my accounts, or at least not in my margin account, because I like to generate income. I like the idea of generating a weekly income. It doesn't have to be the exact same amount every week, but just the ability to generate some sort of income from your portfolio. But if you buy and hold, you can't really control the income or the profit, because you sort of have to wait. You're at the mercy of the market if the stock's going to go up or not. And also the entry, you're at the mercy of the market in terms of the entry as well. You have to wait for a dip before you can buy something. But that's why I think I'm going to leave the registered account just to buy and hold, just to take advantage of these stocks that are doubling and tripling. And then I'll use my margin account to generate that income. So in my TFSA right now, I've got BABA. So when BABA dropped all the way down to 212, I was able to buy some at 225. And you see right now it's at 263. And when the market opens, it's going to be around 268. So it's showing me already a 20% profit almost. I've got Bell here, which is for dividends. Pays almost 5% dividends. I've got Bank of Nova Scotia for dividends as well. And you see the stock itself is up 26%. I've got Choice Properties for dividends as well. I've got gold, just to buy some gold. That's the only one. That's actually my biggest loser in my registered account in my TFSA. I've got Manulife for dividends, and it's up 26%. I've got MMP for dividends. It's up 14%. At some point, it was up much higher, so I guess it dropped. I've got Realty Income. It's up 2%. It's also for dividends, of course. I've got Pizza for dividends. It's up 10%. I've got RioCan for dividends. It's up 25%. I've got Smart Centers for dividends as well, and it's up 2%. And I've got AT&T. It's up. It's probably not even up. It's up 0.5%. And I've got TD. That is up 17%. So all these are for dividends, as you can see, and it's kind of fun to just buy and hold. And I've got available cash. So in my TFSA, I'm sitting on available 3,500 Canadian cash and 32 US cash. It's kind of fun to just be ready to buy something in case it dips, and just buy and hold. So I want to be able to do both. So that's what I'm going to do in my registered accounts. I could change my mind. If you've watched my older videos, you'll see that I keep changing my strategy. I guess I'm just adapting with what I'm seeing, and I'm learning every day from my mistakes and what I actually see from the market. But for now, this is what I'm going to do. I'm going to use my registered accounts to buy and hold stocks, and I'm going to put in $1,000 at a time whenever I make a purchase. And I'm going to use my margin account to sell options. All right, so that's my TFSA. So in my RSP, I already had covered calls. But as soon as I can close them, then I'll switch to buying and holding, and putting in $1,000 at a time. So I already started with Luminar. I put in $1,000. I'm already down 2%. But I put in $1,000 in Luminar, bought it at 33. The stock's at 32 now. I bought a SPAC, OACB. I bought it at 10.94. The stock's at 11. I bought another SPAC here, TSIA. I bought it 13.95. It's actually up 26%. So I'm actually tempted to sell this. It's a quick, bought it at January 26th. So it's a quick profit. So I'm really tempted to sell it, but I have to stick to my plan and just hold. But I'll be really annoyed if I see it drop below 14 and I didn't confirm the profit, which usually is most likely that's what's going to happen. But I have to stick to the plan, which is just buy on a dip. And when I bought this, it's because it had dropped a lot that day. So I bought some, and it actually dropped even more afterwards. So I didn't buy at the best price. But right now it looks pretty good. But I'm going to have to hold on to it and just stick to the plan, even though it's very tempting to sell and take the profit very quickly. So the other positions in my RSP, they're covered calls. I've got a box covered call. I've got Rocket covered call for February 19, 22 strike. Actually, let's see where it stands. So I bought the stock at 21.67. Stock's at 21.21, but I'm collecting premiums every month as I go. And see, the thing with covered calls, I like covered calls, of course, but the problem is you need to buy 100 shares. So you end up putting a lot of capital. And if your entry wasn't good, you end up putting in a lot of capital and you're down, let's say 10 or 20% on that big amount of capital. So I don't like the fact that it takes up a lot of capital, and if you had a bad entry, then it impacts your portfolio, and then the call premiums that you're selling, they're going to be worth very little, might not even be enough for you to sell calls. But of course, if the Qs, for example, the ETF, the Qs, if they drop to below 200, then I'm definitely going to put 100 shares in the Qs and then sell out of the money weekly covered calls on the Qs if that happens. But right now, there's no way I can buy 100 shares of the SPY or the Q. Prices are at all-time highs. Also, if I stick to covered calls, then I would never buy something like Tesla. But if I accept the idea of buying stocks and spending $1,000 in each purchase, then I probably could have bought Tesla when it was at $200 pre-split and just held it forever. So I feel like in order to participate in these kind of growth, I have to buy and hold instead of doing covered calls. And for example, Virgin Galactic here, SPCE, I bought the stock at 23.6. I bought 100 shares. Right now, the stock's at 57. But that doesn't matter because I sold a covered call at 23. So my max selling price on this is 23, regardless where the stock is. I did collect a lot of premium on the way, but I miss out on this capital appreciation. And finally, in my RSP, I've got Stick here, another SPAC. Bought it at $14. It's worth $13.85. But I'm collecting premium. And finally, in my RSP, I finally closed Intel, and I have Corsair right now that's at a 30 strike. Bought it at 35.96, but I sold a call option at a 30 strike. My max profit here is the premium collected, which was about $1.50. So see, my max selling price is 30. Bought the stock at 35.96, but I collected $7.44. So here, let me show you how this works. So I bought the stock at 35.96, but I collected $7.44 from the call option, and my maximum selling price is 30, which is my call strike, as long as by, what's my expiry? February 19. So as long as by February 19, Corsair is above 30, then that'll be my selling price. I'll lose my shares at 30, so minus 30. So my profit will be $148 in this case. But it's a decent return divided by 28.52. That's 5% return. I bought the stock January 21st, and if I can get out February 19, that's in a month's time. So 5% in 1 month. That's the idea of selling covered calls. Is if you look at the annualized return, it's pretty high. But the hard part is always finding that return every month. You're constantly looking for these plays, and it might be hard to find. It's time consuming. And what happens if Corsair drops below 30? What if the stock didn't go up like it did and it decided to drop 20 or 30%? Then I'm stuck holding the stock, and then the call premiums that I'll be selling will be might be very little, not enough for me to sell. I do see it has earnings February 9th. I hope nothing crazy happens. We'll see. All right, so that was my portfolio update. So if you have any questions, leave in the comment section below. Any suggestions as well, I'm open to suggestions of what to purchase. Leave them in the comment section below as well. Like always, if you can open an account with Questrade to trade on the stock market, use my referral link below to get $50 in free trades. Also check out the other referral links below. If you enjoyed this video, click the like button, share with a friend, and subscribe to the channel. Thanks for watching.